What do you really know about your investments and your financial advisor? Gary Sinderbrand, a veteran advisor and founder of Better Path Training, has spent decades helping both financial advisors and their clients get it right when it matters most. Gary pulls back the curtain on the advisory world to reveal the truths, the gaps, and the opportunities that most people never hear about, but absolutely should. It's about more than money. It's about legacy, trust, and making sure the people you care about are in the right hands. Welcome to If the Public Only Knew. Now here's your host, Gary Sinderbrand.
Fear has an overwhelming impact on what we do on a daily basis. Now, fear sometimes can be rational. Other times it can be healthy. It's not the same as being afraid. What you do and how you manage that fear oftentimes is going to determine what the outcome of any situation might be. The issue we need to talk about, and you have to be very upfront with your clients on, is that news that they take in externally as an investor is basically designed for them to keep their eyeballs on it because some algorithm knows they're going to read it and pay attention to it, and their vision of the future is going to be reshaped by a series of things that are going to appeal to them emotionally. So we call it behavioral finance. I call it just too much information. The problem really starts with this. If you can't control your emotional response to a particular set of circumstances or even information, there's no way you're going to be a successful investor. Warren Buffett must have 50 of these types of quotes. By the way, when he thinks up this stuff, it's timely, and it's also timeless because it absolutely makes sense. So you need to understand how your client reactions to their perceptions of outside events is actually going to go. It's a series of biases, and these biases are programmed in by what they expose themselves to on a more frequent basis. They're also emotionally triggered. Most of these biases that people hold are the result of a negative emotional experience. Now, negative emotional experiences are stored in a different part of your brain than positive experiences. Pretty easy for you to remember the worst experience you ever had. But what did you have for dinner 2 weeks ago on Monday? No clue. It's stored in there, but it doesn't matter to you. What you're doing instead is you're storing these emotional reactions, these fear-generative reactions. You're basically holding them in, and you're doing it as a client at your peril. And as an FA, you have to address it and get rid of it. They fall into a few different categories. Confirmation bias. I'm only going to read something that agrees with what my current position is. Experiential bias. This happened last time. My experience last time I did this was bad. Therefore, I'm not doing it again. Loss aversion. Yeah, I know I bought the stock at 60 and it's now 30, but I don't want to take the loss. Here's the newsflash. You already took the loss. With the exception of maybe some tax implications, that's what the money's worth. I'm going to hold that stock until I get even. Oh, okay. So what you're saying is that there's nothing better you can do with that money between now and then until you get even. How do you know you're going to get even? Well, it was at 61, so it'll be at 60 again. I said, it could be at 0. If you still want to hold it, would you buy more? Well, no. Okay. So you're holding an asset you wouldn't buy today at that price, but you don't want to sell it. What it comes down to is they don't want to actually take the hit and recognize the mistake they made. So they'd rather torture themselves over a long term and just look at that mistake month after month after month, it being dead money. Familiarity bias. Interesting. I don't understand how real bonds work, so I'm going to hire a mutual fund manager to let them do it for me because they're professionals. Here's how bonds work. You buy them. They pay you coupons. You get your money back at some point. Here's how mutual funds work. You buy them. You have no idea how much money you're going to make or if you're ever going to see your money back again. Familiarity bias. I'm going to buy what I always bought. Recency bias. Market's going up. It's going to continue to go up. Market's going down. Going to continue to go down. Take a look at inflows and outflows of mutual funds on any Dalbar study. And this is one of the few things that I can say with a great deal of confidence. Whatever the public generally believes is always wrong. It doesn't change. Everybody says, get in the market. We got to buy. Got to buy. Great. Sounds like a good idea. Who's left to buy? Everybody says sell. Okay. Everybody's sold. There's no buyers out there. Maybe that's an interesting time to go in.
Oh, there's my phone.
I'm getting a little tired. Gentlemen, it's about
Oh, I told you never call me on the golf course. Then sell. They're all selling, then buy.
Listen to me.
I'll tell you what, let me have the
we
call.
start now?
Any coast.
Gentlemen.
What do you want?
Gentlemen.
So you can give your investors overwhelming evidence to the contrary that they are basically engaged in a series of decisions on their own that involve investor self-abuse. You can give all the logic in the world, it's not going to matter. Fear is going to control it, and it doesn't matter how much you tell them what's happening at the time. We see this in self-guided investors. We also see it in FAs that act as facilitators. Whatever you want, Mr. Client. Yeah, you want to come out of the market? Sure. Yeah, we know it's probably not a good idea, but if you're not comfortable, we'll move in and we'll do that. Oh, so in 2000, let's say 21, with the market going straight up, you basically moved into a growth posture. And we had 75% of our money invested in equities. It was great. We were all making money. What's that? End of 2022. Now you want to be a conservative, mostly fixed income investor? Oh. So your aversion to risk basically changes on your most recent experience. There is so much evidence out there that indicates to people that, driven by their emotions, they're going to be wrong almost all the time. And it really comes down to what I would call financial self-abuse. Logic isn't going to defeat it because fear is going to take control. We see this with self-directed investors, and we see it in the Dalbar studies all the time, how money moves in and out of funds. We also see it with investors that have financial advisors who act more as facilitators. You could talk them off the ledge, but if you didn't prepare them for it ahead of the event that's making them scared to death, you got to let them know up front. Here are the pitfalls. Here are the things you're going to want to do. And if you're hiring me to get you from this point to this point, and we understand what the timeline looks like, that's the job I'm going to do, despite the fact that at some point along the line, you're going to want to do something that doesn't make sense because it's going to be driven by your emotions. Either we got to get all in, we got to get out, we got to time it, we got to do something that is antithetical to what we're doing here. And I will tell you now, Mr. and Mrs. Client, I will resist that with every ounce of my being because I know it's incorrect. Now, if your goals change, we can change them. But what we want to do is take advantage of the volatility, not feed into it. We want to take advantage of how groups think, not go to the other side and just think to ourselves, we're going to be able to time the market, because we are not going to be able to do that. How do you get ahead of it? By immunizing your investors up front before the money goes to work with where individual investors make mistakes most frequently, as well as most FAs. You are there to provide passion to get them to the outcome, but being cold-hearted and dispassionate about how you're going to get there. You have to be able to guide that client despite the impediments that are there. Most FAs, if the client says, I want to do this, that, or the other thing, what do you think? And the FA will come off their complete process-based approach and says, well, look, no one knows the future, and if that's what you feel like doing, it's your money. I don't know if I would do that. And you're all wishy-washy. Don't be. Stop listening to your client. Seriously, don't listen. They're in an emotional fury. They don't know what to think. But if you sound the exact same as you did when you put them to work and you took them through some form of investment introduction, you use some charts and documents that demonstrate how people can hurt themselves in times of market volatility, you can reference right back to it and have your client remember the conversation. Show them the same chart. Sometimes I'd have clients write on the chart, this is where we can get in trouble and Gary will resist. And they'll pull it back up and look at it. And they'll be, so we just got to stay put, huh? If your goals change, your timeline changes. For now, stay where we are. It's going to work. If I'm speaking in that voice and I'm like, oh my God, the market's terrible right now. Look at our performance over the past year. If I'm doing that and I'm getting involved in these short-term performance discussions, I've already given up control. I really have. I wouldn't talk about short, unless they want the money short term. When we put a plan in place, we actively manage an asset allocation to control volatility. We do that by balancing away from overperformance and buying things that underperform. At the stock, bond, and cash level, and also within equities, we would do it at the size and style level. We have small cap growth going through the roof. We're so happy for you. But we also know if it's performing so far outside everything else, I'm going to trim the high grass and move some of that money elsewhere. Do I move it to another allocation, to a bond? I don't know. But I want to have balance as I go forward. I don't want to be a pig. especially if I only need to make 7%, 8%, whatever it might be. I mitigate volatility by explaining upfront to every client I had how we control volatility by taking advantage of other people's fears. Get them through one cycle, they're fine after that. And that really is the secret sauce to getting them where they want to go with less risk than you can possibly imagine.
Thanks for checking out If the Public Only Knew with Gary Sinderbrand. If you found today's episode helpful, be sure to follow the show and share it with another advisor, investor, or friend. For more on Gary, or to check out any links mentioned in the episode, head to the show notes. We'll see you next time.